The environment that we find ourselves in has historically been one in which EMs have struggled. Geopolitical instability, a hawkish Fed, the dollar looking very strong. These have all been catalysts for EM sovereign debt default, particularly in the 1980s and 1990s. And there are some smaller emerging markets and frontiers that look vulnerable this time as well. We've discussed Sri Lanka at length previously. The government there has already defaulted on its debt to foreign bondholders. But the likes of Tunisia, Ghana, Kenya and Ethiopia also look concerning. The governments of these countries have sizable foreign currency debts, low levels of FX reserves, and dollar bond spreads have widened sharply over the past few months. And the other emerging market that, of course, looks at high risk of default on its FX debt is Russia, but that is largely a function of Western sanctions. The government's balance sheet is actually in good shape, but the US Treasury has restricted Russia's ability for bond payments. But coming back to the focus, the other key point is that most major emerging markets are better placed to cope with a stronger dollar and tightening of financial conditions than they have been in previous decades. So since those crises of the 80s and 90s, currency pegs have been ditched in favour of floating exchange rates, and that means that they are typically less likely to suffer disorderly depreciations. FX reserves have been accumulated, which gives policymakers ammunition to prevent currency collapses. And if I had to pick the most important factor, I think it is that borrowing in most of the major EMs is now done in local rather than foreign currency. Now, there are some exceptions, of course, Turkey being one of them, and we have plenty of research on that. But for the vast majority of the big EMs, we think that it's local currency sovereign debt risks that investors should be focused on.